Ladies and gentlemen, good day and welcome to DDev Plastiks Industries Limited Q1 FY26 earnings conference call hosted by Go India Advisors. As a reminder, all participants' lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference has been recorded. I now hand over the conference to Ms. Saloni Ajmera from Go India Advisors. Thank you, and over to you, ma'am.
On behalf of DDev Plastiks Limited, I would like to welcome you to our earnings call to discuss the operational and financial performance for the first quarter of FY26. This session is hosted by Go India Advisors. Joining us from the management team of DDev Plastiks is Mr. Narendra Surana, Chairman and MD, Mr. Rajesh Kothari, Whole-Time Director, Mr. Aryan Bothra, CFO, and Tanvi Goenka, the Company Secretary. Please note that today's discussion may include forward-looking statements which are subject to various risks and uncertainties. I encourage participants to consider these factors when interpreting company developments. With that, I now invite Mr. Rajesh Kothari to provide an overview of the quarter and business outlook and performance. Over to you, Kothari ji.
Yeah, good morning and welcome to the DDev Plastiks Q1 FY26 earnings call. We appreciate your time and continued interest in our journey. Yesterday, our Board of Directors approved the financial results for the first quarter of FY26. And today, we are pleased to share with you our performance highlights, key developments, and outlook for the future. During this call, we will walk you through our financial and operational performance, provide insight into our strategic direction, and articulate our growth roadmap. We'll also shed light on the key initiatives undertaken during the quarter and reaffirm our long-term vision for the sustainable and inclusive growth in FY26 and beyond. Before we begin, I would like to remind you that certain statements made on this call may be forward-looking in nature and are subject to risks and uncertainties. FY25 was an exciting year for us, marked by significant milestones and robust growth in line with our management's vision and guidance. We remain confident that FY26 will follow a similar trajectory, driven by our unwavering commitment to excellence. Thank you, Saloni. Here is a well-structured, professional and speech-ready version of our entire draft polished for clarity, flow and tone. I have preserved all the key messages while ensuring it reads smoothly as part of our formal address. The quarter gone by has undeniably been one of the most eventful and turbulent periods in recent history. Escalating global tensions, both geopolitical and economic, have resulted in a mix of conventional military actions and non-kinetic confrontations such as cyber and trade wars. These developments have fueled significant market volatility across geographies and sectors. The resulting ambiguity has weighed heavily on corporate confidence and international business. Despite such a challenging backdrop, India has demonstrated remarkable resilience. Amid the prevailing geopolitical uncertainties, the Indian economy has emerged as a relative bright spot, underpinned by macroeconomic stability and encouraging trends across key indicators. The previous quarter witnessed an uptick in GST collections, rural wage growth, and government-led capital expenditure at both central and state levels. Inflationary pressures, including on the commodity front, remained soft. Looking ahead, we see multiple macro tailwinds supporting the growth recovery. These include a sharp cut in interest rates, middle-class income tax relief, forecast on an above-average monsoon, healthy showing patterns, easing commodity prices, and surplus banking system liquidity. On the most notable feature of first half of current year 25 have been the swift and decisive policy response by the government and the Reserve Bank of India in addressing emerging economic concerns. The RBI adopted a highly accommodative stance, surprising the corporates with a 100 basis point repo rate cut year to date, alongside a cumulative 150 basis point reduction in case reserve ratio. This was further supported by liquidity infusion by multiple rounds of open market operations and forex swaps. Regulatory relief measures such as the rollback of restriction on certain lenders further reinforced financial stability. On the fiscal side, the government's FY26 union budget stood out for its pro-growth orientation, including the INR 1 trillion income tax relief for individuals, aimed at boosting consumption and sentiments. In a significant boost to fiscal headroom, the government also received a record INR 2.7 trillion dividend from RBI, which is expected to support growth-supportive expenditure through the remainder of the year. After an extended phase of muted capital spending in first 9 months of FY25, the government has decisively ramped up its investments. March 25 alone saw a record outlay of INR 2.4 trillion, and the 5 months period from January to May 2025 recorded a strong 41% year-on-year growth in capital expenditure. The cable and wire segment remains central to India's industrial expansion. Now I will explain you what are the demand drivers in the domestic markets and export markets. The major demand drivers are power generation in renewable through solar and wind energy. And also we are seeing a substantial new investment coming in coal-based thermal power projects and related infrastructure in transmission and power distribution by transmission and distribution companies of central government and state governments. Simultaneously, we are witnessing a resurgence in coal-based thermal power investments, which along with large-scale initiative in transmission and distribution infrastructure by central and state utilities is further accelerating sector demand. We assure that we will continue to grow with the projected percentage what we have stated, and we will try to improve upon it during the current financial year and subsequently. This will be our endeavor to keep the growth momentum in the company on a continuous basis. The Indian wire and cable market is projected to grow at the rate of CAGR of 12%. In line with this growth, leading manufacturers are expected to undertake capital expenditure of approximately 13,200 crores. This scale of investment presents a significant growth opportunity for polymer compound suppliers like us, who form a very critical link in value chain. Over the past 5 years, FY20 to FY25, our company has delivered consistent and profitable performance. Our EBITDA has grown at a CAGR of 28%, with margins expanding from 5% to 11%. Similarly, our profit after tax has increased at a CAGR of 46%, rising from 27 crore in FY20 to rupees 185 crore in FY26. We remain confident in our ability to sustain this growth trajectory. In fact, it is our continued endeavor to outperform our stated targets and strengthen our market position in current financial year and beyond. Due to critical quality requirements and stringent approval process mandated by end users, polymer compound manufacturing is not amenable to outsourcing. This calls for robust quality control mechanisms, advanced in-house R&D infrastructure, and continuous capital investments, making it a high entry barrier industry. With evolving regulatory standards and heightened emphasis on safety and product quality, compliance costs in the wire and cable sector are expected to rise. In this context, legacy players like DDev Plastiks are well positioned to benefit as large, more organized players. Now, the big players such as Adani and Ultratech enter the wires and cable space. DDev Plastiks naturally emerges as the preferred compound supplier, owing to its proven track record and deep industry expertise. As India's largest listed polymer compound manufacturer, DDev Plastiks has effectively leveraged evolving industry dynamics. We are planning to increase our focus on cable segment by adding more capacities in PVC, halogen-free flame retardant, and XLP compounds. Our efforts are commemorated towards adding capacities to meet the global rising demand for cables and allied sectors. The company has demonstrated consistent cash flow generation, sustained margins expansion, and holds industry-leading market share, approximately 50% in Cyberplast and around 33% in XLP, underpinned by a strong balance sheet. In FY26, we aim to build on this momentum by expanding our compounding capacities in XLP, PVC, and halogen-free flame retardants to meet the rising demand for high-voltage cables. Currently, our XLP offering cater up to 72 kV. With the planned capacity expansion, we will be entering the 220 kV segments also. Apart from the capacity, we would endeavor on getting certification for 132 kV for making it ready for commercial use by end of FY26, early FY27. Whilst SFR is expected to get more industry impetus, this upgrade aligns with market trends and positions us to serve the growing requirement for medium and high voltage cable applications. During the quarter, our export orientation encountered challenge due to geopolitical conflicts. However, we successfully mitigated these impacts by promptly redirecting product to the domestic market, where strong demand enabled swift absorption. Despite the prevailing conflicts, our export revenue grew at a rate of 3% year-on-year basis to INR 154 crores. We remain firmly committed to our long-term objective, targeting volume growth for approximately 10 to 15% and revenue growth of 12 to 13%. On a conservative basis, we aim to achieve a revenue of about INR 4,500 to 5,000 crores by FY30. We also expect to maintain a robust EBITDA margin in the range of 10 to 12%. Our strategic focus will remain on enhancing our operational efficiencies, expanding our product portfolio, and delivering sustainable value to all our stakeholders. I now invite our CFO, Mr. Aryan Bothra, to take things forward. Thank you.
Thank you, sir. We at DDev Plastiks are pleased to announce a robust start to financial year 26. For the first quarter, revenue from operations reached approximately 769 crores, representing a 23% year-on-year growth. This performance was primarily driven by sustained strong demand in the wire and cable industry, coupled with a 50 basis point increase in our average selling price. EBITDA stood at 79 crores with a margin of 10%, while PAT was approximately 52 crores, delivering a margin of 7% for the quarter. During the quarter, we continued our capital expenditure programs, adding capacity for Cyberplast compounds of 5,000 metric tons in the eastern part of the country, while bringing our installed capacity to 238,400 metric tons per annum. Production volume saw a healthy growth of 11% year-on-year basis, reaching close to 52,000 tons. Capacity utilization improved both sequentially and year-on-year basis, standing at 87%. Our capex plans remain on track with an expected investment of 110 odd crores in this financial year. Now we request we open the floor for question and answers.
Thank you so much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Archana Gude from IDBI Capital. Please go ahead.
Hi, good morning. Thank you for the opportunity and heartiest congratulations to the entire team for strong set of numbers. So I have 4 questions. Firstly, can you guide us on 23% net sales growth for Q1 FY26 in terms of value and volume? Also similar numbers for Q1 FY25.
Yeah, thank you so much. So this 23% growth has been contributed by 2 things. One, as we have already informed in regards to volume, the volume has grown by almost 13% as compared to the Y-on-Y quarter first FY25. When we see the average selling price, the first quarter average selling price was around 136 rupees, and this quarter we have achieved the average selling price of 148 rupees. Though as compared to the previous quarter, it is a marginal increase of 50 basis points, but when we compare with the year-on-year quarter first basis, it is close to 9% increase. So that is what contributing close to 23% of the growth.
Okay. So you said this 136 rupees per kg for Q1 FY25 and 148 for this quarter, right?
Yes.
So that is roughly 9% growth.
Yes.
And the remaining 13% growth in the volume, right?
Yes.
No, the numbers, right. So secondly, on what kind of revenue should we expect once we receive this 132 kV cable certification? Let's say the fag end of FY26 or maybe, some number for FY27.
Yeah. So here the important factor, 132 kV, the revenue generation, we can expect somewhere in FY27. And
Right.
as we go higher in the voltage rating, the time which is taken for ramping up the volumes is quite long, because you have to get first the cables made, then cables need to get approved, and then the customers will start lifting the product in a small quantum, because it is a measure of trust building. Despite having the certification, the volume growth takes time. So significant volume growth from 132 kV segment alone can be seen beyond 2027, not before that. But the real advantage of being able to deliver 132 kV successfully to the customer and get the approval would be seen in our volume growth for the voltage rating up to 72 kV. Because when people accept you as a good supplier and a reliable supplier, capable supplier for 132 kV, then all their doubts for any voltage rating below that are eliminated, and there you are able to grow your business in bigger way.
Right. Correct, sir. Sir, can you help me with the market size for this segment and maybe what kind of margins are there?
So 132 kV market, see, I will put the market within a bracket of 132 kV to 440 kV. The market size is just 10 to 12% of the total market size for XLP insulation for this category. And realizations are generally 10 to 12% higher compared to a 72 kV product. If we talk about 132 kV pricing, it is bound to be higher by 8 to 12% compared to a product which is offered for 66 kV.
Right. Sir, any update on this capacity addition, what we planned last year, like for FY26, and when should we expect it to start contributing to the net sales?
Aryan?
Yes, thank you. So this is already in fragment basis already happening. As I explained, 5,000 tons is already added in the eastern coast, and now PVC and HFFR are already in process. Probably by third quarter, PVC and HFFR will be completely installed, and those capacities also will be running. 5,000 tons of PVC is already installed in the eastern part of the country in this quarter, and that will be running by next week with their commercial operations. So as far as this PVC, HFFR and XLP initial plant capacities are all in line. We are also planning to increase further XLP capacities, which will be in the second half of the year, probably in the fourth quarter. So that operational capacities will be practically from the next financial year.
Correct. And lastly, there has been very healthy improvement in utilization on YOY at 87% this quarter. So should we anticipate the similar kind of number for rest of the year in terms of utilization, maybe some 87-88% for full year?
So if you see the average growth which we have already projected or estimated, whatever you say, we are targeting a growth of 12 to 13% on a minimum side as compared to the previous 3-4 years. So if you compare the same, definitely we are in line. The quarter-wise volumes may be up and down depending on the environment, because second quarter generally the monsoon season impacts and marginally the volumes become the lowest as compared to any other quarters. So we should not see it is on quarter-on-quarter basis broadly, but when we see the growth, definitely we are on a better trajectory. The demand is very strong, and we see that this 12 to 13% minimum growth is there.
On the volume front?
Yes, on the volume.
Correct. Maybe lastly, I'll just put in one more question on the margins, sir. Somewhere we are shy of 10%, excluding the other income, just in good. But is that this volatile raw material prices is really keeping us away from touching that 11% plus kind of mark? Or is there something I'm really missing out on reading the numbers?
So we see the numbers on the basis of EBITDA per ton, and that too on the gross basis, including the other income, because most of the other incomes are part of our business. They are not separate. So if you see that the last year's average was close to 15,100 rupees, and this first quarter had been at close to 15,300 rupees. So on EBITDA per ton basis, definitely we are improving. Even if you compare with the Q1 of last year, we were at 14 and now we are at 15.3. So definitely the improvement is in there. The base effect of increasing the base prices from average of 137 last year to almost 148 in this first quarter had led to the percentage drop. But if you see the absolute numbers, it is improving on quarter-on-quarter basis.
Right, sir. Maybe my question was more of, what should really we look at to get back to that 11% mark for full year? How confident we are that maybe in H2 FY26 when when we'll have this increasing capacities and maybe higher share of value-added products, and for the full year we should expect those kind of numbers at operating level.
Yeah. So Aryan, I'll just add a clarification.
Please.
We always look at EBITDA or margins as per ton basis. And our focus is to improve the margin on per ton basis, basically. So if the realization per ton goes up, then percentage-wise, it might appear that there is no improvement. That is why my request would be that please look at our forecast and projection with regard to our commitment to or our confidence to see the improvement of EBITDA on per ton basis. And that we have delivered better EBITDA per ton basis compared to last year first quarter, and we continue we hold this view for this entire year as well.
I get it, sir. So I get it completely. Thank you so much, and all the best to the team. I hope similar kind of numbers for the upcoming quarters. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Bhargav from Avid Asset Management. Please go ahead.
Yeah, good morning, team, and congratulations on a good performance and a fairly detailed presentation. Sir, my first question is on this certification of 132 kV. So in our earlier conference calls, what I understand is that we were looking to go live by FY28. But is there any positive development here now that we are saying that we will go live by FY27?
Yeah. So Bhargavji, the point is that product is ready with us, but the next step is driven by the fact that it has to be tried by a cable customer. And we are having a tie-up arrangement with a couple of customers, but unfortunate part is that the trial has not taken place yet. So when we are saying that we will be able to go live in FY27, it is based on the assurance we are getting from our customers that most likely they will be able to take up our product for trial in the last quarter of, or third or last quarter of FY26. It means that another 6 months they will be able to conduct the test and come back with the report approving the product. Then in 2027, FY27, you may have some volume to start with. So this is based on the latest interaction we have with the customer. But here, always you can see a possibility of improvement by a couple of quarters in the timeline and a delay of couple of quarters in the timeline, depending upon how this tie-up delivers.
Okay. Secondly, sir, within the PVC, which currently has about 4 to 5% EBITDA margins, are we looking at some value-added products which can sort of lift our margins maybe to 7 to 8%?
Yes. See, as we see that people like Ultratech and Adani are planning to enter the wire and cable segment, and our inputs from the market and interaction with those the investors indicate that their entry will start from the building wires initially, and that is where the PVC's role is very important, and our margins, because PVC what we are selling is a basket of multiple product. The product which goes for building wire, the product which goes for the general purpose jacketing application also. So building wire per se delivers better margin. So we are getting ready for that opportunity which will be offered to us the moment Ultratech and Adani start their building wire activity, because we are very strong and we have a very strong brand equity as far as this product is concerned. Because every big wire and cable player, you name anybody starting from Phenolics to RR cable to V-Guard, everybody has started their journey for building wire with our PVC compound to create a brand for themselves. So we see no difference in case of Ultratech and Adani, and that is why we are adding capacity, and those products are definitely delivering margin of 7 to 8%. So PVC blended margin might improve as our share for the building wire goes up once these two giants are there in the market.
Okay. Sir, in terms of XLP, is it fair to say that post this FTA with UAE, the competition would have intensified because the import duty on imports done by the UAE-based compounders may have now become zero. So how are we tackling that competition, given that we are also increasing the XLP capacity?
Yes. So here the duties have not gone to zero yet, because they are going down with a the fraction of percentage every year basis. That is one part. And secondly, the people who are supplying from UAE, they are big giants, and then their pricing is not driven by this duty advantages. Most of the time they will try to pocket this duty advantage for themselves rather than passing it on to the customer. So they keep on improving their prices wherever there is a duty advantage. So we have not seen that significant impact. The impact or intensity of the competition is mostly driven by the capacity addition by them. So whenever in say 3-4 years, whenever they come up with the additional capacity, then we face a challenge for say a couple of quarters or maybe 3-4 quarters till their capacity gets absorbed in the market. So we do not see any challenge at this point of time.
And lastly, sir, in your PPT you mentioned America as your focus area. So given the recent development on tariffs increasing to 50%, do we still continue to remain this as a focus area? If you can share your thoughts on that, and that would be my last question.
Yeah, so definitely USA market is a big market and it will remain our focus, because today the challenge is that the cables which are being exported from India to US market, yes, those will face a challenge, and that also for a limited period of time, because people will find ways to retain that market, because they have created this market for themselves with lot of effort. So people are working, as we are talking to all our cable customers. But for us, the opportunity is in a different manner. Not only we are supplying to the people who are exporting cables to USA from India, but we are having UL certification. Today we are having UL certification for one product, and 2 products certification is there in pipeline. Maybe another 5-6 months that certificate also will come. So that will result into an opportunity globally for us. So we can supply to our product to a customer who is based in, say, for example, UAE. UAE has got a lower rate of duty while exporting to the cables to US market. So anybody whosoever is exporting cables to US market will become our customer. Only 2 challenges will be there with us. Our direct export to US will not grow till this issue is resolved. Second is that our proxy export via our customers in India, yes, that may see a bit of it for some time, but at the same time the opportunity will emerge from the other markets, because those customers will come and buy from us.
Okay, understood. Thank you very much, sir, and all the very best.
Thank you.
Thank you. The next question is from the line of Jyoti from LIC Mutual Fund. Please go ahead.
Yeah, hi, sir. Good morning. Congratulations on a good set of numbers.
Hello.
Good morning.
Thank you.
Yes, good morning.
Please.
Yes. So I actually wanted to know, first thing is on a total basis, if you can just guide me what sort of capacity addition do we see for the next 3 years first, and then what sort of ramp up in your total volume can we expect for the next 3 years?
Can you repeat the second question, please?
First is on the capacity addition,
Yes.
and
Yes.
then how do you see the ramp up of those volume for the next 3 years?
Sure. So I will address the first one. So, as far as the capacity addition is concerned, we are adding, when we talk about 3 years horizon, close to 15,000 plus tons of HFFR. We have already added 25,000 tons of PVC, rather planned for this financial year, and if required, we may add another 5 to 10,000 tons. On the XLP front, on the cable, specifically the transmission and distribution part, we are planning to add close to 60,000 tons of capacity in this next 1.5 years time, and that may also increase to another 24,000 tons by next 3 years of time. So on a consolidated basis, we are talking about close to 130,000 plus tons of capacity being added. When you talk about the ramp up, there are two different aspects to it. PVC is, as sir explained, due to the increasing demand expected, it will ramp up with the demand coming in. So it will be a gradual increase. While XLP, we already have a demand in place in India and the global market. So that will see a faster ramp up as compared to PVC and HFFR. So on a consolidated level, we see that average utilization would remain about 75 to 80% on a consolidated level.
Got it. Okay. Secondly, on the margin front, so when we talk about the different KVs, so right now, first, if you can guide like any idea on what sort of, so basically your 6 kV will have what sort of contribution towards the revenue, and so how do you determine the margin based on this kV? So can we expect it to expand beyond 11 also after a given point of time, for example, when your 32 kV comes in? So can we expect that the margin in the range of 9 to 11 can go beyond 13, 14 or 15 also at any given point?
Yeah.
Yes.
Okay. Yeah, Aryan, should I?
Yes, please.
Yeah. So, ma'am, we are already doing a business up to 66 kV. Okay.
Okay.
So the new product line addition which we are talking about is for 132 kV. And definitely margins improve as we go higher for the voltage rating. Say 1.1 kV product will have the lowest possible margin, and then as you grow from 1.1 to 11, then 36, 33, and then 66 kV, then your margins will continue to improve. And then over a period of time, product gets bracketed in rather than individual voltage rating, but in a bigger range. Say for example, today there are 3 categories, I would say. One is low voltage, that is products which are up to 1.1 kV. Then the products which are called medium voltage, they are product up to 36 kV. And the high voltage, which are product for 66 and 72 kV. So every segment will have a couple of percentage better margin as we go up higher. Now, the margins which we are earning today is a blend of margins we get from the lowest end of the product and the highest end of the product. And as the volumes will grow, so our projection is not assuming that volume will grow only on a high-end segment. In fact, volumes are higher at the lower end of pyramid. So volume growth will come from all the segments. So even if we are selling more quantities of high value-added product at a higher end, we at the same time will be selling more product at the lower end of the pyramid also. So blended margins, you will not see much of a difference than where they are today. But at the same time, the introduction of high-end product more and more in our product range and achieving higher volume there would basically protect us from loss of our EBITDA margin because of the growth at the lower end of the pyramid in the volumes.
Got it. In terms of capex for this 132, what sort of capex is there for this one?
No, we already have our equipments ready, which can produce
Okay.
132 kV. So we are, whatever the CapEx which we are planning, they are not specific to any voltage rating, because equipments and the machines are such that they can produce anything starting from, say, 33 kV up to 132 kV in the same setup.
Okay. Any guidance for the quarter two? How do you see can we see some sort of even better margins what we did in Q1? Because Q1 was already good, so can we see improvement in Q2 or it will be at par?
Aryan?
So, with the current situation, we see that it may remain at par because monsoon season generally quarter two remains a sluggish for us. So as of now, we are seeing it at par.
Okay. Yeah, that's it from my end. Thank you so much, sir, and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Arnav Sakhuja from Ambit. Please go ahead.
Hi. Thank you for taking my question. So with regards to the crude prices, so the crude price movement had been a bit volatile this quarter, especially towards the end of Q1. So I just wanted to ask, has this impacted our performance in any way or not really?
Aryan, please.
Yes. So if you see the crude prices in India, it long ago got delinked as far as the crude prices and the demand and supply situation is concerned. So the polymer prices are mainly driven by demand supply. And if you see the last 10 years, there have been a lot of capacity addition by all the petrochemical players in terms of polymers. So in India, it is more driven by demand and supply. However, there are different processes of each different player and different raw material inputs. So when the global prices move as far as the polymer prices is concerned, marginally the prices move here as well. So when we talk about the base prices of selling price moving up by 50 basis points, we mean that there has been increase of raw material prices by that account and that has been passed on. That is why the average EBITDA comes low, but the per ton EBITDA seems to be better. So I just wanted to mix two things to make you understand how things look at our end as well.
Right. And my next question is, I think someone had asked a question with regards to the CapEx over the next 3 years, and you had mentioned that it would be 130,000 tons. So if you could just repeat the broad breakup of this, that would be useful.
Yes. So HFFR, we have committed another 15,000 tons. PVC, we have already committed 25,000 tons, and there may be additional 5 to 10,000 tons as well. XLP, we have committed for close to 60,000 tons, and another 24,000 tons can also be possible.
Okay. Thanks for answering my question.
Yeah. Thank you.
Thank you. The next question is from the line of Guru Darshan from Kitara Capital. Please go ahead.
Thank you. Congratulations on very good set of numbers. Sir, our volume growth is around 12 to 13%, but overall EBITDA growth is around 22%. Most likely is due to lower base, which is around 14,000 per ton in Q1 FY25. Going forward, will you see the same kind of EBITDA growth, or will it be in line with the volume growth, which is around 13-14%?
We see it's in line with the volume growth because EBITDA, as we have continuously mentioned, that we are targeting it to maintain our 15 rupees, and it will be in the range of a broader range of 15 to 16 rupees, to be very precise, I can say. So it will be more driven by the volume growth from here.
Understood. But when you say the realization growth by 50 basis points or 0.5%, are you saying that, we are charging more for the same product, or
No.
Like
We are saying as we have explained earlier also, when the raw material prices goes up, we have to pass on the similar prices to our customers. That is why if you see on a continuous basis, our EBITDA margins, irrespective of the movement of raw material, are on a continuous basis on a stable levels. So from that perspective, when we talk about selling price going up, That means the raw material prices went up and that has been passed on to the customers.
Yeah. So essentially, since we follow cost-plus model,
Yes.
the EBITDA per ton will remain around 15 to 15.5 rupees, right?
Yes, yes.
Yeah. And in Q1, finance cost was around 5.5 crores. Could you explain what exactly is included in this figure and what would be the quarterly run rate of finance costs going forward?
See, on a net basis, our run rate is around 4 to 4.5 odd crores. When you see 5.5 odd crores, it includes processing fees of close to 2 odd crores and normal other cost of balance 3.5 odd crores. Now, since we are already borrowing and investing in mutual funds and FDs, so the income from those are reported in the other income, which is close to 1.5 odd crores. So when you talk about the net interest income or interest cost, specifically, it is net cost is 4 crores approximately. So that is what our target on a net basis is around 4.5 odd crores.
Okay, understood. So regarding the end user industry, so there are multiple variants, right? Power cables, housing wires, communication cables, instrumentation cables, specialty cables and all that. Which of these, sub-segments do we currently participate? And where do you say the majority of the future growth coming from? Could you please elaborate on the opportunity we have?
Yeah.
So, yes,
you can go ahead, please.
So there are 3 broader areas according to me. Kothari can add to that. So one is the house wiring, as Kothari already explained, that the demand is already there and with new entrants, the demand will further go up. So this is an opportunity. Next is the power cables. So irrespective of the normal replacement demand, the new demand is also very strong. With new industries coming in, with new infrastructure work going on, the power cable requirement is also going up. And the biggest demand, as we see, is the distribution and transmission, 1133 kV and beyond, which we constantly are talking about increasing our capacities, is the product where due to solar, due to infrastructure improvement, due to electrification of the entire country, not in India, in the global scenario also. This is a major driver of distribution and transmission cables, which is, I will say, is driving the overall growth. So in terms of percentage growth contributing to the EBITDA, it will always be the distribution and transmission for the next 3 years. Whilst when we talk about the volume growth, it will be driven by all the 3 products together. Kothari, you can add if I missed anything.
No, you covered it fully.
Okay. So just last one question. You're saying that you will add around 130,000 tons of capacity. Do you still wish to maintain 13 to 14% kind of a volume growth going forward? I mean, at least for next 3 years, what kind of volume growth can we expect since you're adding almost more than 1/3 of the current capacity?
Yes. So as of now, for this current financial year, the volume growth will be probably in the similar range, because we are already at a very high capacity utilization levels. Next year, we may see, you can say, a better percentage growth, but that will taper down over a period of time. So when we see this targets of FY30, which we have set for us, this average CAGR growth of 13 to 14% of volume growth is coming from that target. It will be initially higher, probably going down at a later part of the period.
Got it. Thank you so much, sir. Congratulations again.
Thank you.
Thank you. Ladies and gentlemen, please limit to 3 questions per participant and come back in the queue for a follow-up. Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
So thank you for the opportunity. My first question is on the CapEx part again. So I heard you earlier when you said that few of the CapExes are planned across different compounds. So wanted to understand what is the total cost that we will incur over the period of next 3 years on this CapEx, and also the fact that do we have enough land parcels for doing a brownfield expansion, or are we looking at acquiring newer land parcels, or have we shortlisted any land parcel near to our existing facility?
So we have a total land layout of close to 300 plus odd crores against this capacity addition which we announced last year. Now, when we talk about the existing land parcel or brownfield expansion, we have partially some space available with us, and we are looking for lands as per the requirement of the project. So yes, we have identified few, and we are in process of identifying more. It is a continuous process because there are different products, different geographies also to be addressed because of our customer base. So it's a mix of all. It's a continuous process, and we are into it.
So this 300 crores include acquisition of land and the expansion, right? Both.
Yes.
Okay, got it. And also, one thing, that I've noted, since you said earlier as well that there are certain aspects of the other income that is actually operating in nature, I would request you, sir, if you could categorize those income as other operating income, as part of the financial statement. A lot of companies do that. So it gives, the investor a more clearer picture of what is the operating part of the other income and what is the normal, treasury other income. So.
Okay. We'll check with our auditors how comfortable they are on this reclassification, and accordingly we'll do that.
Okay, sir. Sir, thank you. That's all from my side.
Thank you.
Thank you. The next question is from the line of Bhavik Shah from Invexa Capital. Please go ahead.
Yeah, hello, sir. Am I audible?
Yes, you're audible. Please go ahead.
So my first question is, when you're saying we're waiting for approvals for 132 kV, so my first question is, why will customers switch from its existing supplier? Are we more cost effective, or is it only based on the relationship which we have?
Yeah.
Kothari, please.
Yeah. See, the customer will switch over to a new supplier because of various reasons. Today they are fully dependent upon imports, so they would always love to have the localization. Because the demand for 132 kV is not as consistent and as planned as it is in case of, say, lower voltages up to 36 kV. So it is all tender based, and certain times you are having very good demand, and few months you have a drop in demand. So to manage your supply chain well in time to support the demand emerging, you always need to have a local supplier. That is one part. Secondly, if you don't have any alternative to imports, you many a time end up paying very high premium. It has seen in past in all product categories, our Indian cable customers have benefited immensely, not only Indian, but overseas customers who are buying from us regularly. They have benefited immensely by having a credible supplier like DDev Plastiks in their portfolio, so that they are able to get reasonable prices from their other suppliers. Just for an example, when we say that why a customer for 132 kV should switch to another supplier like DDev Plastiks. Now I'll give an example. Say UAE is a place where the gurus is a place they have their plant capacity and they are having some duty advantage over us. Despite that, the customers who are based in UAE prefer continuously to buy certain quantity from us. And also during the challenge of the COVID, when supply chains was thoroughly disturbed, the people who were sitting in Dubai were not able to serve the customers of Dubai or Oman or say Egypt, and the supplier like DDev Plastiks served their needs. So everybody needs to diversify their supply chain so that they do not suffer shortage of material or the price shocks.
Understood, sir. And so my second question is, like when we say the Ultratech and the Adanis will come up with their capacities, like have we spoken with them, or are we confident? How are we so confident that we'll get the orders from them, or is it like we are having some monopoly in the market which will eventually lead us to getting some orders from them?
No, it is not monopolistic situation. Definitely, we do not have monopoly on those products. But see, every product gives you an indirect monopoly. Is that kind of the trust somebody would have on your product? So whenever somebody is launching a new product for building wire, means starting from the Phenolics, which was 27 years back. So starting from Phenolics, RR Cable, V-Guard, KEI, Havels, all these guys, when they came for launching their building wire, the first PVC compound they bought was from DDev Plastiks or erstwhile Kalpana Industries. And later on, they might have moved to other suppliers, but initial few years, they have been our 100% dependent upon us. Why? Because our product has got that capability of running at a high speed, giving very good surface finish, consistent properties, which have been proven over a period of time. Another aspect, just to give you a perspective, even today, whenever somebody is going for BIS certification for any type of their cable, initially, they would prefer to buy material from us. Why? Because they feel safe that yes, if we are buying this product, we will not face any hiccup in BIS certification because product is above standard. Okay, so this is the reason we are confident that these two customers also will be our customer for first few years. That is one, and with both of them, we are already in touch. We do not have any firm RFQ, but we are having indication that they will love to work with us.
Understood. So I asked this question because Adani is also coming up with a PVC capacity. So eventually they might also get into this product as well. So that was the rationale behind asking.
Yeah, but their PVC capacity is far away. We do not see their PVC resin coming up in next 1 or 2 years. This is what we hear from the sources.
Understood, sir. Thank you so much.
Thank you. The next question is from the line of Raj from Arjav Partners. Please go ahead.
Hello, am I audible?
Yes.
Sir, about the capacity expansion you highlighted over next 2 to 3 years. So what will be your overall capex in that?
Around 300 odd crores we have already committed on this.
All right. And how are you going to fund this 300 crore capex?
As of now, since it is a staggered plan which we have done, so we are funding it from our internal accruals. And going forward, if we want to expedite, then we'll look for other alternatives. But as of now, we are doing it from our internal accruals.
All right. And sir, how much of the sales is from USA, direct and indirect sales?
What are it?
Yeah, it is, say, the proxy export via our customers in India could be, I think, close to 100 crores plus.
100 crores plus, okay. So overall sales to US is around 100 crores also?
100 means it is by our proxy customers. We don't export directly to USA. Our cable customers in India who are exporting to USA, so the product which we supply to them for the US market, that could be close to 150 crores. I don't have any precise number, but that's the number.
Okay, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Jaideep Taparia from IDBI Capital. Please go ahead.
Thank you for the opportunity. So I wanted to understand the revenue contribution by product category. So 73% is from polyethylene and 10% from PVC. So the rest 17%, could you just elaborate where this revenue comes from?
So it comes from HFFR, it comes from our EP engineering plastic compounds, and it comes from trading. That is the overall breakup.
Okay. And so by sectors, after wires and cable and packaging industry, the rest 16% is from?
Sorry, maybe your voice. Hello?
So revenue contribution from sectors, the 16%, that comes from?
So it's a mix
of
many segments. It is a mix of many segments. There is footwear, there is automotive, there is FMEG segment. So it's a mix of many segments all put together. So that's why we are highlighting the major segment, and there are many other segments.
Okay. Okay, sir. Thank you, sir.
Thank you. The next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Namaskar, sir, and thank you for this opportunity. Hello?
Namaskar.
Yes, sir. Firstly, sir, congratulations for good set of numbers and also a revamped investor presentation. Most of the points, the outlook, everything has been covered very well in the investor presentation, and kudos to the team for representing the best for us. Sir, when you mentioned about 300 crore CapEx, that will take our capacity up by 130,000 metric ton by 2030. That is what the CapEx for the ensuing 4 years you have outlined, because 110 we are doing for the current year.
110 we are doing for the current year. Last year we did close to 60 odd crores, and another few the balance is planned for the coming couple of years.
So that means 110 plus 60, 170. So remaining 130 is outlined for the remaining 4 years, or 300 is the remaining balance?
So 300 is including the last year and the current year. And we haven't considered the capacity which I have mentioned specifically on the 10,000 and 24,000 tons, which is optional. So if we consider that, then probably another 100 odd crores need to be added. So as of now, this 800 capex outlay is planned up to FY27, and if we talk about the 130,000 tons, we may have to add another 100 odd crores.
Okay, sir. And going ahead, sir, what is our current market share, and what are we eyeing after commissioning of things at 2027 and by 2030, when we are eyeing a top line of 4,500 to 5,000 crore? What would be our market share? I think so segment-wise it would be better to understand in the KV segment or a blended one. How should one take an understanding of the same?
Yeah. So, Ajant, let me take this question.
Yes, please.
So here the market share in each segment, it is difficult to define. But when we are talking about the growth, so we are looking at the opportunities which will drive us to achieve those numbers which we are projecting for 2030. Okay. So in that, one segment is XLP compounds. So today our products are having a product range of up to 66 kV. And that segment, starting from 11 to 66 kV, our market share is 1/3 of the total Indian demand. We are having 33% market share. Now, this is an area where we see a significant growth opportunity for ourselves. Why? Because the Indian cable customers are adding huge capacity in this product category, this segment. B, by going up the value chain for a product which is capable of delivering insulation properties up to 132 kV, we are attaining the capability to secure higher market share with all our customers for volume range up to 132 kV. So this is a segment which I would say starting from 11 kV to 132 kV XLP insulation market, where rather today it is 66 kV and going forward 132 kV, where our current market share stands at anything between 30 to 33%. We want to take this market share beyond 50%. So this is the biggest growth driver. That is one. Second is halogen-free flame retardant. There we have multiple times in our earlier conferences also we explained that we see this market growing at a good pace, which was a close to 25,000 tons per annum kind of a market, which we see with a natural progress, whatever it is showing at the moment, should reach close to 100,000 tons per annum kind of a thing by 2030. And there we are planning a capacity of 20,000 already we have committed, and we are anticipating probably we'll add more capacity there. So we'll have much larger share in that market. Today our market share is negligible in that segment. Market is very small. So both the things will happen simultaneously. Market size will grow and our market share will grow. So these are the two product segments which will drive our growth.
Right, sir. Thank you, sir, for elaborating and giving us very good understanding. For the solar cable part, sir, how are we classifying that incremental demand for our compounds? Specifically, if you could just give the volume growth which we have experienced, how much would you attribute to the solar cables?
So, see, HFR demand growth, the key driver is the solar cable application. So, if you look at our capacity starting from 5,000 tons and ending up at 25,000 tons by 2030, so it is the kind of 5 times growth in that product segment, and majority will come from the solar side.
Okay. So HFR is the one that is attributable. The growth is inclined towards the solar cable growth only. That is what you are alluding to.
Yeah. Major portion of it.
Okay. So there is a specification for which HFR will be used while the manufacturing of solar cables are needed?
Yeah. It is so. See, halogen, because there are many products which can meet the specification which governs the solar cables. But halogen-free flame retardant is the most optimum product which will deliver you right value at right price point, covering all the properties which are required for solar cable application. Like to specify, say, for example, the weather resistance, weatherability, because the cables are going to stay in open environment for a longer period of time, higher level of UV stability, higher level of flame retardancy, safety against fire. So all these features you can incorporate in the most cost optimum way with halogen-free flame retardant. You cannot achieve the same through PVC or XLP.
Correct, sir. And when we see other solar cable manufacturers, they mentioned about E-beam cross-linked solar PV cables. So are these the same, or there are also various types of cable?
Yeah, no. The cross-linking mediums could be different. Okay, you can cross-link a halogen-free flame retardant cable. You can cross-link chemically. You can cross-link it by E-beam. So we are having products which are suitable for both kind of cross-linking. Chemical cross-linking as well as the E-beam cross-linking. So my customer, whatever way they are making the cable and cross-linking it, we have the product and we are going to have the market share for that.
Okay. And last point is, sir, what would be the current capacity addition for this halogen-free retardant for this financial year and the next year?
Aryan?
Yes. So if you see the current capacity, we are already at 5,000 tons. Another 5,000 tons in process of installation. So that's the balance will be done probably by end of the second quarter, and will be ready with this capacity on a commercial basis probably from the month of November. So you can anticipate that this year we'll be having we will be closing around 10,000 tons of HFFR, and then the following year we'll be adding another 10,000 tons.
तो सर इसका रेवेन्यू कंट्रीब्यूशन अरेन भाई क्या रहेगा इस वर्ष के लिए 10,000 टन का?
रेवेन्यू कंट्रीब्यूशन मोर और लेस आप ये सोच सकते हो कि ब्रॉडर बेसिस में 250 से 300 करोड़ बाय FY28 हम एंटिसिपेट कर रहे हैं.
दैट इज एट 20,000 की कैपेसिटी.
यस.
ओके, तो ये 10,000 में भी 225 करोड़ 125 वी कैन एक्सपेक्ट.
Yes.
Okay, and the margins will be EBITDA per ton will be higher for this product, higher than 15.
Yes. 15 से थोड़ा सा बेटर है.
ओके सर. एंड सर लास्टली सर इसमें हमारा मार्केट से मैंने करंटली एग्जिस्टिंग और कौन से प्लेयर्स हैं हु आर मैन्युफैक्चरिंग दिस?
शकुन पॉलीमर्स.
ओके, एंड देयर आई थिंक द IPO is due for them, so they are not the listed players.
Yeah, they are privately held. Yes.
They are a subsidiary of a Mexican company.
अच्छा सर. Okay. Thank you. So this will be the value-added product from which we will be eyeing to further profitable growth and the incremental margin. That should be the understanding going ahead.
Yeah.
Thank you, and all the best to the team, sir, for setting up a good show and good start to the financial year, sir. All the best, sir. Thank you.
Thank you. With this, I think the time is almost over now. I will request our CMD sir to give the closing remarks.
Anyway, good afternoon, everybody. So I thank everybody, every participant, for their, very effective and very relevant questions. I hope that our team has been able to answer all the questions in the right perspective, and everybody must have got the right perspective of the company. So thanks once again for participating in this investors call. Thank you very much.
Thank you. On behalf of Go India Advisors concludes this conference. Thank you for joining us, and you may now disconnect your line.
Thank you.